30 minutes until the start of trading on this Thirsty Thursday. I'm Matt Miller.
I'm Dani Berger. Bloomberg Open Interest starts right now.
Back in business, the government shutdown is officially over, but investors are bracing now for more volatility as the data fog slowly lifts.
Disney taking the earnings spotlight this morning. The company says its new Avatar movie and other blockbusters will weigh on their results.
Plus, famed investor Michael Burry deregisters his hedge fund with the SEC, saying that he's moving on to much better things.
Like a vacation or something? I don't know what's better than running your own
Playing
hedge
the
fund.
drums in a metal band.
That is much better. All right, one of the stocks we're watching this morning is Cisco. They are showing progress in their efforts to capture AI, but there you go. Shares are up 5.8% in the pre-market this morning, and you can guess why. Because they talked about AI, saying that they're capturing the spend from AI tech giants, and Matt, it raised its guidance saying that they had sustained demand.
All right, we gave you a sneak peek, but going the other direction, shares of Disney. After reporting earnings that fell short of Wall Street estimates, Disney also warned of big budget films that will weigh on results for the first quarter of its fiscal year. As a result, the House of Mouse is down almost 6%.
Let's get more on said House of Mouse. Joining us is Bloomberg Intelligence media analyst Geetha Raghunathan. Geetha, they're spending more, but these are the kind of projects that bring big audiences with it. What is the balance to be concerned about costs versus the slate of programming they have that will be a boon for Disney?
Yeah, excellent question, Dani. So yeah, it is a very, very tough balancing act for Disney. As we kind of look to fiscal 2026, I mean, this is a blockbuster year for the company. I mean, you just look at some of the films that they're putting out, starting with Zootopia 2, then you have Avatar, you have a live action Moana, you have Toy Story, Mandalorian. So it's just one big release after the other. And of course, they are going to have some costs associated with that. But remember, Dani, I mean, this isn't just about box office and theatrical performance. Studio IP is so important because they have so many different ways to monetize that. I mean, this is the whole content flywheel. I mean, this becomes the source of IP at the parks, which is, again, a huge income generator. It becomes a source of adding more subscribers at Disney Plus. So for them, investing in that content is really important. And so, yeah, it's a little bit of short-term pain for a lot of long-term gain.
So what is the growth business for these guys? Because I know the parks is sort of the meat, right? That's the cash cow. But what are the shooting stars for Disney?
Parks is actually one of the shooting stars. So as we just kind of look at this business, I mean, it has transitioned, from what used to be mainly a linear network business to now kind of this streaming destination. And Matt, if you just look at the parks and streaming, just those two business segments are bringing in something like 73% of profits next year. So those are the major sources of earnings. I mean, just parks alone is about 60% of total company profit. And if you just look at the investments that the company is making, I mean, whether it's cruise ships, whether it's expansion, whether it's adding, new attractions, new rides, adding completely new worlds like the world of Frozen at Disneyland Paris next in 2026. I mean, these are investments that is, going to pay off big dividends, I think, in the long run for them. So parks and streaming, those are the two big earnings growth stories.
All right, Geetha, thanks so much for joining us. Geetha Raghunathan covers Disney for us at Bloomberg Intelligence. Now, network equipment giant Cisco boosted its 2026 forecast as AI demand remains strong for its products used for chips and networking gear. Bloomberg's Ryan Vlaselica covers the sector and joins us from Chicago. So, Ryan, Cisco, it's funny because this was kind of the poster child of the internet bubble burst in 2000. So many comparisons between then and now, but they're making up money on AI.
Yes, good morning. Thanks for having me. So yeah, it's funny you mentioned the dot-com era because after the stock fell in the wake of that bubble, it has yet to recover those levels. It is getting very close right now. I think we're going to be a couple of percentage points away based on pre-market trading. But it is kind of interesting that the big winner of the last technology revolution is going to be starting to be a bigger winner in the current one fueled by AI. It gave a very strong forecast last night raised its estimates for both earnings and revenue, talking about increased demand for all the networking gear that is used in AI, all the data centers, all the servers, and so forth. So a pretty strong report from a company that has otherwise been sort of a slower grower, more mature, much more of a legacy name than some of the growth names that have been such big outperformers this year.
Ryan, in February, Cisco also announced that it had a partnership with NVIDIA. For this company, how much of its fortunes are increasingly tied and dependent on that partnership, especially when it comes to outperforming their peers?
Yeah, so I think there's a big component of that, but just in general, the increased demand for AI, all of the spending that's being done on AI, we are starting to see it trickle through to Cisco in a much more pronounced way. There have been some signs of this, some strong earnings reports over the past few quarters, but it does seem like, hopefully, at least for the company, this is going to be something that becomes a little bit more sustainable and durable as far as the acceleration.
All right, Ryan, thank you so much. That is Ryan Vlastelica on the latest on Cisco. And tune into Bloomberg Tech, 11 a.m. Eastern, a live conversation with Cisco CEO Chuck Robbins. Now, elsewhere in Washington, D.C., the longest U.S. government shutdown in history is over. After 43 days, federal employees can go back to work this morning. President Trump spoke last night from the Oval Office.
I'll sign a bill exactly like we asked Democrats to send us all along. Many days ago, this cost the country $1.5 trillion, this little excursion that they took us on. It's an honor now to sign this incredible bill and get our country working again. Thank you very much.
Bloomberg senior editor Mike Shepard joins us now from Washington, D.C. Mike, maybe business back to normal, but what has been altered from this shutdown? Are we going to get data, for example, that we missed last month?
Well, it's a great question, Dani, because the data that were supposed to be collected in October never got collected. And there really is no way to turn back the clock on that. And yesterday, White House spokeswoman Caroline Leavitt indicated that those numbers would probably be lost forever. We do expect the Bureau of Labor Statistics in coming days to provide a revised timetable on when they might be able to start releasing some of the numbers that we might have missed and what might be coming next. But like so many other operations, the data production and issuance was really disrupted by the more than 6-week halt in federal operations. And it is going to take days to restore a number of other things. And that includes the SNAP benefits that were disrupted by the shutdown. It could take up to a week for that food aid to go out. And if you're thinking about making air travel plans, the Transportation Secretary Sean Duffy is warning that it could be a week before the shutdown-related flight restrictions are lifted. So there will take some time, Dani, before some of these after effects all wash away. And we have to look ahead also to early next year. Most federal funding actually lapses again on January 30th. So we could be staring at another showdown over federal spending before we know it. Now, one of the key questions is whether the Affordable Care Act subsidies that Democrats have been demanding an extension of as a condition of voting for this bill, whether those would be a factor in another confrontation, that remains to be seen. Democrats are indicating that they will pursue another means of trying to get those voted on, and if not, they will look to take that and turn it into a midterm election issue.
Shep, I got to ask about the Epstein files. The White House has really been pushing back against releasing these. Pam Bondi, the AG, who said she had them on her desk, then later denied that they even existed. Now we've got a new representative sworn in whose signature has made it possible for a motion to move out of Congress to get these files released. Are the Republicans going to let them out?
Well, it's a good question. And what we are seeing, though, is that there is some Republican support from at least 4 Republican lawmakers, Thomas Massie, Nancy Mace, Marjorie Taylor Greene, and Lauren Boebert, who have backed additional disclosure on the whole question of how much the president knew about the disgraced financier Jeffrey Epstein's activities, which included sex trafficking. Jeffrey Epstein died in prison custody in 2019, but there is still a lot we don't know. And there are questions about how much the president knew and what the extent of his relationship was with Epstein over the years. And they are looking to get the Justice Department to divulge more. Yesterday, we did see a trove of emails released by a House committee, about 20,000 documents in all. In some of those emails, Epstein suggested that there may have been more to the president's knowledge of his own activities, Epstein's activities, but it's unclear what those documents actually mean and point to. And the president yesterday vehemently rejected any suggestions to the contrary, that he knew more than he had said, and he called the documents released yesterday, in his words, a Democratic hoax.
Hey, Shep, thank you so much for that update. That's Bloomberg's Michael Shepard in Washington, D.C. A check on futures this morning after a day where equities barely moved yesterday. Sentiment struggling to pick up. Maybe it's because of all the hawkish voices that have come out from Collins to Daly in the past 24 hours, making the odds of a December rate cut more like 50-50. So you're looking at a 0.5% decline for the S&P, and the Nasdaq MAT down 0.7%.
All right, coming up, Disney falls short as the film studio expenses weigh on the current quarter. We'll hear from the CFO of the parks and streaming company, Hugh Johnston, next. This is Bloomberg Open Interest. Let's get now to high interest. Look at what's making headlines around the world. In an exclusive interview with Bloomberg Television, Ukraine President Volodymyr Zelenskiy urged Europe to unlock billions of dollars in frozen Russian assets to sustain Ukraine's war effort. He said President Trump could send a good signal by doing the same with Russian funds held here in the U.S.
This decision, this way of sanctions was good, as I said to you, that it was American sanctions and European sanctions. It like split, and they came together, and I think this is good way. It was good way, and that's the same about assets. That's why I raised it about assets, that there are some assets in the United States. If the United States can do it, it will be helpful for European decisions also.
Newly released emails from convicted sex offender Jeffrey Epstein show exchanges with former Treasury Secretary Larry Summers, as well as Goldman Sachs legal chief Catherine Ruemmler and ex-Trump aide Steve Bannon, many criticizing President Trump. Summers predicted Trump's world will collapse, while Epstein called him dumb. The documents also include Epstein claiming Trump, quote, knew about the girls the White House blasted the news as a partisan smear campaign. And Michael Burry's Scion Asset Management has terminated its SEC registration, signaling a major shift for the Big Short investor. The move took effect on November 10th. According to filings, Burry, who famously bet against the housing market in 2008, hinted at, quote, much better things coming on November 25th. In recent weeks, he's revealed bearish bets on both Palantir and Nvidia. Dani?
It hurts to be short this market, I guess, at the moment. Speaking of things that are hurting this morning, a look at some of the rate movers on our radar. Memory chip stocks, they're down pretty sharply across the board. SanDisk doing the worst, down 5.2% in the pre-market. Japanese firm Kioxia reported dismal results, so this boom-bust sector is feeling the bust today.
Alibaba is climbing after Bloomberg reported it is revamping its AI app to rival OpenAI's ChatGPT. So it looks like the Chinese threat is being taken seriously and bet on by investors.
Meanwhile, Dollar Tree, it got a double downgrade by Goldman Sachs. It says any further upside for the retailer is getting harder to see, though shares down 3% in the pre-market.
Coming up, Disney drops on a revenue miss, and we're going to hear from the CFO of the House of Mouse, Hugh Johnston, next. This is Bloomberg Open Interest.
Check on Disney shares this morning, about 10 minutes until the market opened, down 5 1/3%, falling pre-market after missing on fourth quarter revenue estimates. We welcome Bloomberg Tech co-hosts Ed Ludlow and Caroline Hyde, and they are joined by Disney CFO Hugh Johnston. Take it away.
Thank you very much indeed. It's wonderful to be joined by you, Hugh, with Ed and I across various parts of America. Hugh, just first start with us for a moment, will you? Rating Disney's overall fourth quarter performance. You were strong in parks. Look, you were strong in streaming, but there was some weakness in films and TV. Talk us through how you rate yourself.
Yeah, actually, I thought it was a good quarter overall. And frankly, versus Wall Street, we beat expectations by 6 cents. So as you noted, the experiences business did very, very well. 6% revenue growth, 13% OI growth was terrific. Sports did very strongly while we were launching the new DTC product, which is off to a great start. And then in terms of the entertainment business, it was largely just the overlap of the film slate that drove the numbers. I know the linear business looked a little bit soft, but that's primarily due to the fact that we had India in the numbers last year where we made $84 million and wasn't in the numbers this year. Take that out, apples to apples basis. Overall, I thought the quarter was good. And it actually allows us to end the year with a lot of momentum. As we think about where we are right now, we grew EPS 19% for the year and 19% CAGR for the last 3 years. And that's why we both guided to double-digit EPS growth in 26. And on top of that, doubled the share repurchase and increased the dividend by 50%.
Hugh, good morning. On that momentum, the focus for a lot is streaming, right? And you have the confidence to say streaming is going to continue to be profitable through 2026. What are the factors behind that? What allows you to have the confidence to have such visibility into how that streaming business is going?
Well, of course, streaming always begins with the quality of the content that we have and the quality of the slate that we have going forward. So if you think about the film slate we have right now, number one, we obviously have Zootopia 2, followed by Avatar, followed by The Devil Wears Prada 2, followed by Toy Story 5, Moana, and then we've got an Avengers movie as well. So if I look at all of that playing its way into the streaming service, certainly feel good about those tentpole events. In addition to that, our TV side continues to perform very strongly. The ratings are great. The number of hit shows are great. And then on top of that, we're investing in the product in a significant way, creating a unified app, and in addition to that, improving our recommendation engines and improving the navigation within the DTC app. Put all of that together, and what we really see is just a huge opportunity for growth. We aspire to grow that business double digits, along with the double-digit margins we expect to achieve this coming year. And as a result, I think we're going to continue to see that business do really well and be a real growth driver for Disney.
But the profitability, Hugh, streaming operating income for the first quarter of 2026, you guide to be $375 million. That's a lot less than the Street was anticipating. Why is that?
I think it's primarily due to the fact that we're investing in product in the business and we're investing in bundling. So we all know that bundling ultimately is a very profitable thing to invest in. It increases retention, reduces churn, increases engagement, and that's not a theory. We have proof on that. But initially, when you do bundling, you're making an investment. On top of that, the things I was talking about related to recommendation engines and the like, all of that requires some investment in the early part of the year, but the paybacks on that are going to be tremendous. So we certainly feel great about it. And for the full year, the double-digit margin we guided to is very much in line with what we had indicated a year ago.
Hugh, how close are Disney and YouTube TV to a resolution? And what do you plan to do that kind of gives our audience right now a sense of what your strategy for distribution is on how you resolve that?
Well, in terms of where we are right now, it's an active negotiation. So that's obviously going to be driven by both sides. We don't control that. What I can tell you is we put a very attractive deal on the table, very much in line with and in a few areas perhaps better than what we're doing with others. And we feel like we're making the right proposal to value the content that we create and to give consumers access to this great content on YouTube. That said, if YouTube chooses not to engage with us on that front, obviously that content is available elsewhere, and our expectation is that at some point consumers will shift to other opportunities.
Well, consumers want ESPN. and consumers could get ESPN, the streaming app, performing. At the moment, how do you measure your own success there?
Yeah, it's early days, obviously. The product's only been in the market as of the end of the quarter, about 5 weeks. So far, off to a great start. And we think about it from two perspectives. Number one, the perspective of are we getting engagement? And the answer is yes. People love the SportsCenter for You capability. They love the Discover Sports capability that we have. In addition to that, in terms of the subscriptions that we're getting, 80% of those are bundled subscriptions. So it's not just benefiting ESPN, it's benefiting the entirety of the Disney Plus ecosystem. So we feel great about it from both perspectives.
Right.
It's off to a great start, and what we've seen is engagement goes up when people do subscribe to the service.
Hugh, is this the last earnings report and quarter before Disney's board names a successor to Bob Iger as CEO?
That's a great question. So what the board has previously indicated, and I will say the board has been about as transparent as any CEO succession I have ever seen in my long career. What the board has indicated is that will take place sometime during the first calendar quarter of 26. We report in next February. Whether that'll be before or after will be up to the board, but we should have it done by the end of March.
Disney CFO Hugh Johnston, great to talk again. Thank you very much. Matt.
Thank you.
Thanks
Good to be
very
with you
much. Hugh, really appreciate your time. Ed and Caroline, always great to see the co-hosts of Bloomberg Technology. Their program kicks off at 11 a.m. and to hear more about the streaming business, the movies that are planned. For me, it's all about the parks.
Yeah.
You know, I have now a 5-year-old and a 2-year-old, so I've reached that point where I'm ready to spend literally all of my 2025 income down in Orlando for a couple days. Then we're going to go on a Disney cruise.
But, okay, you say it's all about the parks, but I feel like I've heard you sing Moana songs and Frozen songs, so the content
I do love
gets
those.
you, too.
For me, I mean, I'm editorializing now, but
yes.
I find Encanto to be absolutely the best, above all of,
it's so good.
Of the Disney
The
princess
songs are superior.
Movies. Quick check on futures ahead of the opening bell. We're looking at a little bit of a drop here. Seema Shah joins us next. This is Bloomberg. Moments away from the start of trading on this Thursday. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at stocks that are down, futures off a little bit, 0.4%, 0.6%. You had a disappointing earnings report out from Disney, and concern really that the government reopening is going to lead to more data, which will make stocks more volatile. I don't know about that logic, but that's what I'm hearing. Down the New York Stock Exchange, TKO makes a deal with Polymarket, ringing the opening bell. Dana White is there in the black polo.
Ari Emanuel in the blue suit.
Ari Emanuel there in the blue suit, and well, a lot of high fives and stuff. Maybe they should fight. By the way, TKO stock, it's up like 400% over the last 5 years. I just ran a comp function, so they have been crushing it. Not the case for BGIN. Which is like a crypto thing. They've only been trading at the NASDAQ for a couple of months, but have already lost 41% of their value.
Maybe they should also fight.
I think I would want to if I own those shares.
All-out brawl done at the NASDAQ. Not an all-out brawl here for Cisco shares. Just minutes into the trading day, 5.5% is the gain we're looking at. It's showing progress in its efforts to capture more of the AI spend from tech giants. It also raised its guidance on sustained demand, Matt.
And Disney, we just heard from the CFO, Hugh Johnston, reported sales that fell short of Wall Street estimates. They also warned of big budget films that will weigh on results for the first quarter of the fiscal year. And we got actually a list of them. Zootopia 2 is one, another Avatar, I don't know what number that is, Toy Story 5.
Toy Story 1000,
yeah.
You know.
So they're planning a ton of sequels, and I guess those are going to cost a lot. Kevin Hassett says the October jobs report will be released without a jobless rate. Investors will be quick to react to incoming economic data after a dry spell due to the government shutdown. Principal Asset Management Seema Shah says the winners in today's market will likely be those who adapt quickest to shifting signals without overreacting to the noise. And Seema, I guess we're preparing for what? More noise in terms of economic data?
So I think that as the data comes out, investors have been starved of some kind of direction, and I think there'll be some swings, but ultimately it's going to settle down once there's a narrative and people can find their way. I think it's going to be really important, of course, to eventually get some of that labor market data, at least to give the Fed an idea of exactly how to conduct their policy over the coming months. So I think that's going to be the most important narrative forming over the next couple of weeks.
Seema, you have had, and this is something Neil Dutta pointed out over at Renaissance Macro, that you have the hawks at the moment being much more loud than the doves. Collins among them yesterday, Daly saying that there's a premium waiting to decide on rates. How much do you think that's eating into some of the gains we see in this equity market? We're down this morning. How much is this a stock market hinged on getting a cut in December?
Yeah, I think that's been really important. I mean, one of the things that I think initially had been expected is that with the shutdown and the lack of data, the doves would have the loud voice. But that has been the exact opposite of what's happened. The hawks have been much louder. And that has really weighed on, as we can see from market expectations for December cut, having shifted from, I think, around above 80% a few weeks ago to just 50-50 now. And the market does need, or at least it believes it needs, to have some kind of stimulus in order to ward off any potential further labor market slowdown, maybe help the consumer a little bit, which is showing some signs of stress. So I think, unless the Fed is going to come out and say we're not cutting rates in December because we believe that the economy is very strong and we have the data to back that up, I think the market would struggle if it doesn't get the cut that it's hoping for in December.
Seema, are you worried about, we hear so much about this K-shaped economy, and we get a lot of news about, the bottom half, which is more than half, suffering. 42 million Americans are on food stamps. The biggest amount of people defaulting on car payments since we've been keeping data. And prices for everything, affordability is just one of the big problems. And if we continue to put stimulus into this economy, the president wants to send checks to people, the Fed may cut rates. Doesn't that just drive inflation higher and make affordability worse?
I mean, it's a really good point. And actually, I would say that even the K-shape part of it and how the Fed can help is really, really questionable. One of the things is that, look, the high end, the really top income households, they're driving so much of the consumer spending that it almost overwhelms any of the weakness from the bottom. So I think from the Fed's perspective, it's really tough. And to your point, any further cuts which maybe reinvigorate inflation pressures or push it further, the lower income groups are the ones who have been most exposed to the tariff-driven inflation so far, something that we would expect to continue. So I do think that the Fed is very much stuck in terms of how they can successfully perform their policy moves without having some inadvertent impact coming through too.
Seema, what do we even make of the K-shape right now? Because you could look at some of the earnings like P&G that suggest people are still spending. There has been some pushback in this idea that the divergence is growing, not least of which, if the rich are getting richer, they have a lower propensity to spend as an overall percentage of their income and net wealth. Is the K-shape really getting that much worse, or is there some confirmation bias going on right now?
I think you're absolutely right. So actually, because when you start to really unpack the data, it's questionable whether it's getting worse or if it's just kind of staying pretty stable. From the numbers that we're looking at, it does look to be quite stable. I think one of the things that we do see, though, is that top 10% of households are very much exposed to the equity market. So further equity market gains are really kind of pushing them further and further. The other thing to think about is that there's a lot of emphasis on Q1 when the tax refunds come through from the One Big Beautiful Bill. Now, a lot of that is going to be skewed to the higher income households. And to your point just now, they're the ones who actually spend less of their income, right? So the consumer multiplier impact is that much smaller. So there's a lot of emphasis on that point, but it's questionable about how much that's truly going to feed through to consumer spending growth next year.
I was looking at the Mag 7 performance over the past week, over the past month, over the past 3 months, past 6 months. It's been phenomenal, to say the least. I think everyone in this market knows that. If you already own those stocks, though, Seema, what would you buy? I mean, when someone comes up and says, I have new money to invest, where should I put it? What do you tell them in this market that's already run so far so fast?
Yeah, I think that's the key question for investors right now. Where do we go? And one of the sectors which I think is still performing well, has got potential to continue to drive higher, is still financials. We are expecting a robust economy. Some of that is on the assumption that the Fed is going to be delivering a couple of rate cuts over the coming year or so. But certainly the yield curve, the way that the market is moving, we do think that financials can do well. And then importantly, if you do have concerns about technology and a potential bubble, there are other parts of the world which have less exposure. So for example, Europe, it has underperformed the US in recent months, but it doesn't have that tech exposure, or it has less of that tech exposure. So if there were to be a problem, well, you'd be somewhat insulated there. But I think importantly, have exposure to technology, but at least have some kind of exposure to cyclical growth. If you, on the hopes, of course, that the economy is going to perform 2026, so that some of the cyclicals, if we do get rate cuts and the economy is continuing to deliver in terms of positive growth, well, then there could be a time next year where small cap really starts to perform well. So I think there's a lot of options out there. It does take a little bit of trawling. And ideally, we need the data to give us that guidance on what to expect over the coming months.
Seema, does that mean now is a bad time to just buy the index, considering whether it goes up or down is really pinned on what NVIDIA is doing on the day?
I mean, look, concentration risk is something that I think we've all been battling with for years now. If you're buying into the index, all you're doing is, you're essentially just getting more and more exposure to technology. So I think having much of a bottom-up stock pickers approach is important, and really active management, because, concentration risk, that is when you want to be actually having that deeper analysis to try and pick out which are the winners, where the ones that you can diversify in case that concentration risk does start to turn quite ugly.
Hey, Seema, really appreciate your time this morning. That's Principal's Seema Shah. And partially I asked about NVIDIA because it seems to be the thing that's driving this market this morning. Let's get a check on it, because NVIDIA, one of the biggest movers to the downside, if you look at a pretty even number of stocks that are up and down. But it is yields that are moving higher today, and that seems to be pressuring tech. Your 10-year yield is up about 2 basis points. So let's go straight to the losers this morning, because NVIDIA down 2.6%. It is moving this index down 14.5 points. That's what happens with this concentration. Broadcom having a tough morning. Alphabet, again, it's these longer duration stocks that get hurt when interest rates seemingly maybe will not be cut in December. It's moving more to a 50-50 coin toss in the markets. Apple, those shares are higher. Cisco, we talked about the good earnings coming from AI demand. Those shares up 4.5%, but not enough to rescue this overall market, which is down this morning. You see kind of a similar trend when you look at the sectors. Most of the sectors are down this morning, and it's been the year-to-date winners. It's communication services, it's info tech, consumer discretionary, utilities at the top. It is energy. Energy outperforms up 0.7%, but that's just a rebound from a very bad day yesterday with expectations that OPEC will put more oil into the market, Matt.
All right, Dani, thanks very much. Dani, looking at the stock movers there just about 10 minutes into the session. Coming up after a huge bet against Palantir, Michael Burry, although not as huge as we may have thought, Michael Burry has deregistered his hedge fund Scion, teasing better things ahead and being pretty specific about the date, November 25th. We'll talk about that next. This is Open Interest.
A tough morning after a really nothing day yesterday. By the way, shout out to Dan Curtis. 11 days for this equity market without a new high. And that's something we haven't really seen this year. Usually we're kind of getting a weird melt up every single day to a new high. But the NASDAQ down 1.2% about 10 minutes into your trading day. All right, let's look at some of the top calls, the analyst action that we're focusing in on this morning. First up, Goldman Sachs, the rare double downgrade to Dollar Tree, moving it to a sell, saying that upside from here gets harder. They flag pressure for low-income shoppers and say peers like Five Below are attractive, so shares fall 2.5%. Next up, Wells Fargo, they upgrade Nike to a buy, saying the sportswear giant is lacing up for liftoff. That's what they said. That's not our pun, I promise. Shares are up 1.5%. They cited improving visibility on sales and margins and expect Nike's slump in earnings estimates to reverse over the next 6 to 9 months. Next up, Circle gets upgraded after JP Morgan said it reported solid third quarter results. They lifted their price target, saying Circle's push to bring more of its dollar-backed stablecoins onto its own platform should drive growth for investment. Those shares down 1/3%, probably, Matt, because they didn't include a pun. I mean, the sell side, Really loves their puns.
It's pretty good, actually, lacing up for liftoff.
Is it?
I mean,
do you lace up for a liftoff?
I don't like saying it. I wouldn't want it in my copy, but reading it is fine. And that's kind of what Michael Burry is doing. Hedge fund manager has terminated Scion's registration status with the SEC. Burry rose to fame, of course, for his 2008 bet against the U.S. housing market. He says he's on to much better things on November 25th. That's the liftoff, but we don't know exactly what that is. Bloomberg finance editor Tom Metcalf joins us now. Tom, this is a fascinating story. We're all very interested in what Burry does ever since The Big Short, played by Christian Bale. What an amazing character. Why would he deregister his hedge fund? Is he just cashed out and taking his toys and leaving?
Yeah, I mean, look, that's certainly one interpretation. So there's a couple of things that could happen. You only have to be registered if you have more than $100 million of regulatory AUM. And at least as far as we know, Scion definitely still had that, at least back in March. They had about $155 million. So yeah, what this would suggest, if you're going to read it one way, is, perhaps Burry is, shuttering to outside investors, or perhaps shuttering the whole hedge fund. He's obviously did that before. He did that in 2008 with the predecessor firm before coming back in 2013. But it's just such a Michael Burry thing to do. He's popped it out to his followers on X, and understandably has prompted a bunch of speculation because should be clear. All we know for certain is they've had their registration. His firm's had his registration terminated at the SEC, and the most extreme interpretation of that would be, that he's shuttering his firm. But of course, there's a whole range of options that could be the case. And, we're obviously trying to get more clarity, trying to reach him. But he's pretty gnomic at the moment and has not yet commented any further.
Giving a specific date of November 25th is incredibly confusing, Tom, but maybe it speaks to the whole thing of markets can stay irrational longer than you can stay liquid. In this post on X, he talked about some of his puts, some of his Palantir bets. Tom, how much of this is just Michael Burry confronting with a market that's incredibly hard to bet against?
Yeah, I think he's, repeatedly said how sort of frustrating that can be. He's effectively taken a few, again, quite cryptic, but a few dings at the AI boom and effectively saying, look, the markets are way too exuberant around that. And yeah, part of his post was around that Palantir short he put on. And he's actually having a bit of a, ding at the media saying, the reports you might have seen of a 900 million position, he spent 9.2 million building that position. The 900 million was the notional value. Which is obviously how those instruments work. But yeah, no, it's one of those ones where you don't, there's a lot of interpretation of his comments going on, and I think everyone really needs him to come out and say, maybe it will be on 25th when he comes out. He's just building up the anticipation, but what exactly is happening here? And perhaps on the 25th there's a new fund, or perhaps he's going to reveal some monster new bet or something.
All right, well, we're definitely all looking forward, Tom. Really appreciate your reporting there. Bloomberg's Tom Metcalf covers finance for us out of London. It's interesting to note also that the Palantir puts Burry sold, as you saw in his tweet there, give him the right to sell the shares at $50 a piece in 2027. They're currently trading at $180. So they need to fall pretty significantly before that $9 million bet pays off. Yeah, well, that, and plus he's been, who knows what other, bets he has against AI, considering he's been railing against that too, and betting against AI would be super painful in today's market too. So maybe all of that feeds into his decision. If he's shorting, right? Because then you have to pay the carry. But if you just bought the puts, you can just leave them there until. Yeah, but you still lose money. You don't get money on those puts. Yeah. Anyway, coming up, memory chip stocks. Those are falling this morning. A peer raises some red flags. A painful session for AMD. We'll get the details coming up next on Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Quick check on what's going on with stocks. Just about 22 minutes into the session, we're looking at the S&P down again, 0.2%. The NASDAQ off more than 1% now. So getting hit pretty hard. And talk in the market is that the government reopening is going to lead to volatility for stocks because of all the data that we get. Really, it's just about NVIDIA falling again 3%. We were down 3% with NVIDIA on Thursday, and the market still managed to eke out a gain at the close. Cisco going the other direction as the maker of gear to run the internet, says it's profiting well off of AI. Disney had a problem with costs and revenue fell short because of streaming. And then Flutter Entertainment, the gambling company, down 8.5% on earnings. SanDisk and Western Digital, these are chip makers. They essentially are commodity companies, right? Because that's what the memory chip business is all about. They had a rival in Japan with a bad earnings report, Dani, so they're down on that big, but maybe this time memory chips aren't commodities. Maybe it's different this time because of high bandwidth memory.
Yeah, maybe the AI changes everything. Let's ask that question. As you say, a Japanese peer to those stocks reported earnings that showed revenue fell 16% from a year ago. Bloomberg Intelligence analyst Jake Silverman joins us now. And this is a sector that is really fickle because of that boom and bust. To Matt's point, is it different this time because of the high bandwidth demand coming from AI?
Yeah, well, so this report from Kioxia is not really related to high bandwidth memory because it's NAND specifically and not DRAM. But those tailwinds.
You got to explain what that is. NAND and not DRAM.
Yeah, so NAND is more a storage, whereas DRAM is, you're more like your typical memory. And high bandwidth memory is something that we're seeing a lot of really robust demand for, specifically in servers. But you also have storage in those servers as well. You can think about like NVIDIA server racks, like GB300, Blackwell, stuff like that. But really, so all of it, though, is still interrelated, and the demand tailwinds are still relatively the same right now. But we're seeing a number of different factors that are driving the demand. So it's not just AI, although that is probably the most significant tailwind. But we're definitely seeing demand for PCs, premium smartphones. So those are also contributing factors.
So this sell-off that we have in Western Digital and SanDisk, 7% seems pretty punchy. Do investors are they looking for an excuse to sell because it's a down market? Have they bid these things up because of AI?
Yeah, I think it's just elevated expectations. I think specifically for Kioxia, I think some of the headline numbers are a little bit backward looking, but if you look at their guidance, it was a little bit disappointing. I think elevated expectations expectations had risen coming into the quarter, just as pricing has continued to increase. So NAND spot pricing, if you look over the last week, it's increased on an average of about mid-single-digit % per day. So the demand continues to increase, and a lot of that, again, is driven by AI. It's a tight supply and demand environment, so that bodes well for pricing. And if you listen to the commentary from Kioxia last night, really what it really is said is that they expect a tight supply and demand environment through calendar 26. And that really echoes a lot of the peers in the industry, especially ones that have exposure to data center enterprise, which is really AI.
Jake, how much of this is also just about the fact that on the limited supply, you don't have a lot of players, and they need to adapt and change really quickly? Who is leading the way? Just how fierce is competition for these memory chip stocks right now? Yeah,
I mean, it's very competitive across. If we take a step back and talk about high bandwidth memory also, so that's, SanDisk doesn't really compete in that, but Micron, Samsung, SK Hynix all do. And that demand is incredibly strong. All of them are vying for share with NVIDIA, as well as other servers that run on ASICs that are designed by Amazon, Google, and also increasingly other companies like Microsoft as well. So everyone wants to be into those server racks, but that's still true of storage as well, because you need to be able to get into those servers, provide that storage in order to generate bit growth for these specific companies. So they're competing, and it's very intense, and it is somewhat commodity-like, and that's really, it's less unit growth, and it's actually more pricing growth that's really been driving increased revenues and profits for these companies.
Jake, great having you on. We've been watching this trend this morning. Jake Silverman, Bloomberg Intelligence analyst. Coming up in the next hour, NewEdge Wealth's Cameron Dawson sees volatility ahead, but that means an opportunity to buy the dip. This is Bloomberg. We are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Dani Berger. A tough start to the day. Stocks drop again. 11 days without a new record.
Coming up back in business, the government shutdown is officially over, but now investors are worried about more volatility as the data fog lifts.
Meanwhile, White House economist Kevin Hassett says that the October jobs report will be released, but without the reading of the unemployment rate.
So without the household survey. And Disney taking the earnings spotlight this morning, but not in a good way. The company says its new Avatar movie and other expected blockbusters will weigh on the results. The problem is you just don't know if they're gonna be blockbusters, right?
Come on, if it's an Avatar, people are definitely, that's why they're doing all these remakes.
Did you?
People are gonna see it.
So have you seen both Avatar 1 and 2?
I have indeed.
And you enjoyed them?
I don't even remember what happened in them, but I think I enjoyed it in the moment.
Exactly. Just not as good as I thought they were gonna be, considering the amount of money they spent on those.
They look cool, though.
Tentpole events. We begin with markets bracing for volatility as the economic data blackout comes to an end. Seema, Shah of Principal Asset Management, weighed in.
As the data comes out, investors have been starved of some kind of direction, and I think there'll be some swings, but ultimately it's going to settle down once there's a narrative and people can find their way. I think it's going to be really important, of course, to eventually get some of that labor market data. At least to give the Fed an idea of exactly how to conduct their policy over the coming months. So I think that's going to be the most important narrative forming over the next couple of weeks.
Joining us now is Cameron Dawson, NewEdge Wealth Chief Investment Officer. Cameron, are you worried that this data deluge, I guess it's not fair to call it that because it'll be slow and only partial, is going to cause any problems for this market? Because we didn't have any problems without data.
Yeah, well, and that is a little bit scary, and hopefully it doesn't set precedent that we don't get as much data as we used to get. It could be a source of volatility. These have been incredibly benign, very low volatility markets, not just within equity markets, but within fixed income markets as well. Look at the MOVE index continuing to fall lower. So it wouldn't be surprising that we see some volatility in reaction to this. But the reality is that you've seen positioning reflect that uncertainty. You still have institutional positioning that is just neutral, whether you're looking at the Deutsche Bank survey or you're looking at the Goldman Sachs index, which just suggests that there are still institutions who need to buy dips and likely need to buy dips into the end of the year as they sat on the sidelines of what has been a monster rally.
The dips feel like they're coming a bit more furiously, Cameron, and it's the AI that's being questioned in a way that it really felt like it hadn't to start the year or midway through this year, to the point where you had Meta, for example, putting out debt into this market and it was easily eaten up. Yesterday, Applied Digital did a junk bond deal to fund data center construction, and that went really poorly. It wasn't really well digested by the market. Is there a real reappraisal of some of the AI themes that previously weren't subject to gravity?
Yeah, we wonder if 2026 will be the year that some of the chickens come home to roost, because what you're seeing is a pretty big deceleration in the earnings growth rate of the mega cap names that are spending all of this capex. You have a name like Google going from over 30% growth in 2025 to just 10% growth next year. Meta decelerating from in the high 40s to potentially negative growth next year. So that just leaves a lot less leeway for investors to be able to say, spend as much as you want to spend, because it is actually starting to hit the numbers to the downside, and that there's not nearly as much for them to show for it on the upside. So the big question for us is that if the stocks do trade weaker potentially into 2026, does this cause some of these companies to question some of their capex plans, just like that happened back in years like 2022 and 2023? That's not necessarily our base case, but it's certainly something to watch, because it could definitely take even more air out of the AI trade.
At what point, though, Cameron, do investors start to lose the faith? Like, OpenAI is not publicly traded, but they want to spend $1.4 trillion, and they have $13 billion, we all know now famously, in revenue. So at what point do investors say, hey, you're not really making enough money for those spending plans at all, not even close, not even in the same universe?
Yeah, that's the funny things about bubbly type of environments, which is that we don't necessarily know what straw it will be that breaks the camel's back, but eventually markets will push back when certain spending plans or valuations get to the point that just simply can't be justified. But the problem that you have, and this is a great quote from Bob Farrell, is that exponential price moves go further and longer than you think, but they do not correct by going sideways. So we're still in this environment where there seems to be a chase higher, but on the other side of it, the rationality typically comes with pretty pronounced downside.
And how telling is it that you have someone who's really, though, been questioning this trade in Michael Burry? He was writing about it this week, this idea that tech is different now. It has depreciating assets, and that's going to mean it's going to weigh on its future CapEx. That he's thrown in the towel, Cameron. It's kind of what you're talking about right now. You could have these ideas that things feel frothy and bubbly, but can you even really do anything about it at this point?
Yeah, well, he is telling us that wait for November 25th, or something bigger and better is coming. So let's see what happens with that. I mean, our approach to this, it has been that you've been able to make the argument that things are stretched in valuation, certain trades are very crowded, but being early is the equivalent of being wrong. So then it has to take another aphorism, which is dance while the music is playing. And that's why we're always very disciplined in watching things like technical trends and really balancing them with what's going on within narratives. And what's interesting to us is that you're starting to see some of this relative performance in things like the overall tech sector, but growth more broadly start to soften and roll over. If that starts to give us a signal that some of these trends are being even more challenged, then the narrative will likely follow. And it's always important to remember is that narrative follows price and not the other way around.
I wonder just quickly what you think, Cameron, about the rest of world trade. Yesterday, we were talking about Peter Oppenheimer's call that the outperformance ex-US is going to continue. Not that the U.S. market is doing poorly, but that, other markets, he focused especially on emerging markets, are going to be doing better for the next decade. What do you think of that call?
Yeah, hope springs eternal. There have been calls that emerging markets are going to converge in performance with the U.S. over the course of the last decade, and nothing could have been further from the truth. And for us, it really comes down to the dollar. The only time you see sustained non-U.S. bull markets is when you see sustained dollar bear markets. And one of the things that's interesting is that the dollar has been firmer over the course of the last 6 months or so, could be rolling over as it hits its 200-day moving average. But unless you're making a call that you're going to see a significantly weaker dollar, as well as something like a big commodity super cycle, which is very important typically for big EM cycles, it likely means that these rallies or periods of outperformance are just simply flashes in the pan versus something that's more sustained.
Cameron, really great to get your thoughts. Thank you so much for joining us. Cameron Dawson of NewEdge Wealth. A look at these markets about 30, 40 minutes into your trading day. It's higher yields that seem to be weighing on things after Collins and Daly throwing cold water on the idea that we'd get a rate cut in December. We are on track for the third consecutive down day for the NASDAQ 100, down nearly 1% off some of its lows. The S&P down about 0.5% after rallying for most of this week, but was little change yesterday, Matt.
All right, let's get a look at some of the single stocks moving at this hour. Cisco boosted its 2026 forecast, showing progress in its effort to capture more AI spending. And as we heard from Ryan Vlastelica in the last hour, Cisco is about to finally reach the peak that it hit before the dot-com bubble burst.
Only it took them a few decades.
Yeah, imagine buying the stock at the top and, that's when a lot of participants in the market do buy in, and then waiting 26 years.
That would be like nerves of steel to hold on, and an incredible opportunity cost that you would have had by just holding on to Cisco. Let's check on the ADRs of Alibaba, by the way, because it's preparing to overhaul its main mobile AI app in the coming months. It would help it more closely resemble OpenAI's ChatGPT. So those shares up 2.4%. Again, another rival to U.S. AI coming out of China.
And Disney reported disappointing sales and said a slate of big budget sequels will weigh on results next quarter. As Disney faces challenges in the new year, there are also questions on future leadership. We heard earlier from the CFO, Hugh Johnston.
What the board has indicated is that will take place sometime during the first calendar quarter of 26. We report in next February. Whether that'll be before or after will be up to the board, but we should have it done by the end of March.
For more on Disney, we are joined once again by Bloomberg Tech co-host Caroline Hyde. Caroline, the drop in Disney this morning, 8%. It rivals the drop we saw in early April on Liberation Day. I mean, this is a stock that investors seem quite disappointed with their results.
Well, sales are flat. Profitability actually dropped, but they are trying to say that they are investing in the business more broadly at the moment, and we'll have jam tomorrow, maybe not today, but it's going to be back-ended in the second half of fiscal next year. You're right, really, at the moment, we're trying to wait for the dividends to be brought back in. I mean, ironically, they are paying higher for dividends. They are doing a stock buyback to try and placate, really, the ongoing capex that they have to put in the business. We asked Hugh Johnston very kindly on your show a little bit earlier about why, for example, is the operating profit coming in way less than expected in the fiscal first quarter all around streaming? Well, that's because they're having to invest in bundling. They're having to invest in the marketing of said bundling. But ultimately, they'll unify. It'll be clearer. And they think they'll get more bang for their buck. Same with the new avatars or the new Zootopias. You have to put a lot of marketing budget behind that if you want to have some sort of reward at the end of the day in a box office splash. Again, jam tomorrow. And remember, they've been doing like a 10-year investment plan in their cruises, which I know you're interested in, Matt. And it does pay off. I did go on one this year, and it was pretty amazing. I went there all cynical, and I thought it was great because they are getting these new ships, but that costs a lot of money. And sort of Bloomberg Intelligence are saying there are some risks to come, but actually they think financially they're being conservative in some of their outlook for next year.
Well, I mean, it is pretty conservative that every single movie he talked about was a sequel, bar none. They have no new movies coming out. It's all part 2, part 3, or part 5.
Name broke.
And they have a sequel as a CEO as well, right?
Oh,
Bob Iger was good-nighted, and then, you know, they drew him back in. When are we going to see a successor? When are we going to see a new CEO at Disney?
Well, I talked to Ed Ludlow, my co-anchor, and he really thinks that the market moved on that answer coming from Hugh Johnston. That, look, by the end of March, we will have an answer. Who will that be? Will that be Dani Walden? Will that be Alan Bergman? Will it be the people who are in charge of the entertainment side and the streaming side and the films and the box office? Or will it be your park side? Will it be Josh D'Amaro? Many are still thinking who are going to be the front runners. It does feel like it's going to be an internal name, and the board have been purely focused on this. Of course, ex-Morgan Stanley CEO has been leading that, other key executives on the board as well. So we'll have to see whether really we get a sequel that's going to work this time, or whether we get a whole new... I mean, they're all internal candidates, so in a way it's a sequel, right?
Well, yeah, fair enough. Very good point. When it comes to Disney Plus, there's this great journal story today talking about the wave of streamflation, and Disney was the worst. Since 2019, they've raised their prices 172%. Can they keep doing that?
On the streaming side.
On the streaming side.
Because in the parks business, it's got to be more like 300 or 400 or 500.
It feels like you personally know this. You feel it. You feel
well,
it.
Well, especially you don't want to jump a queue, right? I mean, if you're waiting in line, then maybe you get a cheaper ticket.
That's
you want
speaking
VIP
of the
access.
the K-shaped economy is alive and well
It is.
at the Magic Kingdom.
But I think, look, all of these streamers gave us a product that was too cheap to try and get market share. And now they're trying to ramp it up, make it actually work from a business model perspective. And I do think they're managing to wring out profitability more broadly from streaming. Finally, they are profitable. But you're right, they have had to jack up prices. But within that, they're doing these bundles. You're not just getting a Disney Plus. You're getting an ESPN within that. You're looking at how you can access HBO Max, of course, that is Warner Brothers property. So they're trying to do more with less, but it always feels we're in constant state of evolution is never there. It's more revolution. We're going back to a whole bundling capacity.
It also feels it's like, hey, we're going to take away the NBA, but give you this and take away that. Like every day, it feels like a new package.
But you can't get it on YouTube. And I think that was a really important conversation that they're saying that they're trying to get some sort of deal done with YouTube, and people want to see ABC. They want to see ESPN properties over there at the moment. This is costing them real money on a daily basis, the longer that this draws on.
We want to see football as well, but not basketball on TV, right? I mean, basketball is only fun if you go.
That's not true.
To the show.
Basketball's so fun. It's so fast.
On TV?
Yeah, like
everything's more fun live.
I like to watch it in the garden, but on TV, and they score like 500.
Except for F1, that is not a spectator sport. Got to watch that on TV.
That's for sure. That's for sure. All right, Caroline, great interview with Ed Ludlow. Her show comes up in just about 45 minutes' time. On this program, Ukrainian President Volodymyr Zelenskiy says his country's survival depends on aid from allies in the war with Russia. We'll bring you more from our exclusive interview next. This is Bloomberg Open Interest. Let's get to high interest now. Look at what's making headlines around the world. Michael Burry's Scion Asset Management has terminated its SEC registration, signaling a major shift for the Big Short investor. The move took effect November 10th, according to filings, and Burry, who famously bet against the housing market in 2008, hinted at, quote, much better things. Well, it wasn't even a hint. He actually wrote it out on November 25th. It's a real clue. In recent weeks, he's revealed bearish bets against both Palantir and NVIDIA. We'll be following this story closely for you. Billionaire Cliff Asness says AQR Capital is exploring a move into sports betting as Wall Street piles into the booming business. Speaking on Bloomberg's Odd Lots podcast, Asness said analytics-driven betting fits AQR's quant style, although he admits he's still wary of the hype and pitfalls involved with real gambling. And the October jobs report will be missing a key piece of data, the unemployment rate itself. White House economic advisor Kevin Hassett said the household survey wasn't conducted because of the government shutdown, meaning the report will only include job gains from businesses this month. He addressed reporters in the last hour outside the White House.
The September jobs report has already been cooked, and we expect we might get that next week. It just hadn't been released. The October employment report for the payroll side will be able to be calculated, but the household survey wasn't completed. So we'll get sort of half a jobs report. Most everything else, I think, we'll be able to concoct the correct number after we look back. But we will never know what the unemployment rate was in October because there wasn't a household survey.
Caroline Levitt of the White House trying to get economists upset at the Democrats, saying the Dems may permanently damage the federal statistical system with an October CPI and jobs report that will never be released. Okay, elsewhere, Ukrainian President Volodymyr Zelenskiy is employing European Union allies to overcome their divisions on the use of frozen Russian assets. He said that fresh funding is critical for sustaining his country's war effort. Bloomberg's chief European correspondent, Oliver Crook, spoke exclusively with the president in Kyiv.
We need it very much. This is one of the types of real sanctions. Russia has to pay for this war. They began this war and they have to pay. This is a real fact, how they can pay. And we need this money. We will spend this money on renovation. And of course, we need air defense. And you know, we need air defense from the United States. And we have European systems. We need this air defense from European leaders. This is all very important. And of course, we need to finance our drone production, which is huge. We need to finance it, and we don't have additional money. And this is the way, and this is fair, I think. They began this war, and they want to continue it. That's why they have to pay.
Is this the most significant thing European leaders can do right now to help you?
Of course, we can get more than 140 billion for today. Right. We can get it. By the way, from the United States, it will be also a good signal, you know, like with energy, like sanctions of the White House, of President.
What?
Yes, it's about Lukoil and Rosneft and Lukoil. Important step. And it brought some our partners, European partners, also to some strong decisions. And we've been happy that there have been 19th package. We are thankful to Europeans for this. So that's why if President Trump, for example, will decide that he has more than 5 billion he has of assets, maybe he will decide to spend this money. It will help.
Have you discussed alternatives with allies about Russian assets if that does not come through? Is there an alternative plan? Is there a plan B?
No, they understand that we need their support, and if I hope, God bless, we will get this decision, but if they will not have this decision, of course, we together will find we have to find alternatives. It's a question of our surviving. That's why we need it very much, and I count on partners.
And on the question of, you brought up Donald Trump in connection to the Europeans, why did it take Donald Trump to get the Europeans to ban Russian LNG?
He always said that he wants Europe to put sanctions on Russian energy. He always said that was during our meeting and etc. And you know that some countries in Europe, they really used it. Yes, it was not the case of 1 year. In the case of, I think, about 30 years, they had relations and a lot of different factories. They have common businesses. It's understandable. And then President of the United States, he said, okay, I'm ready, and if Europe will be ready. And of course, this decision, this way of sanctions was good. As I said to you, that it was American sanctions and European sanctions. It like split, and they came together. And I think this is good way. It was good way. And that's the same about assets. That's why I raised it about assets, that there are some assets in the United States. If the United States can do it, it will be helpful for European decisions also.
That was Ukrainian President Volodymyr Zelenskiy speaking exclusively with Bloomberg's Oliver Crook. Still ahead, David Auerbach of Hoya Capital on what he calls a contrarian opportunity in REITs. This is Bloomberg Open Interest. Let's get a check on the stock market right now using the move screen. This is the S&P 500. You can see that we actually have, once again, breadth to the upside, but the index is off more than 0.5% right now, even though 278 winners and 220 losers. Maybe this is good. You need a broader market, at least according to Bob Farrell's rules, in order to hold gains. The problem for this market is NVIDIA, right? Once again, as on Tuesday, it's down almost 3%, and it's dragging down everything else. Take a look at the industry groups here on the S&P 500. Healthcare, energy, and consumer staples are all doing well. Communication services, these are the hyperscalers, as well as IT and utilities are underperforming. Coming up, our next guest says the brutal 3-year stretch for REITs has created a buying opportunity. David Auerbach next. It has been a brutal run for REITs, the worst on record, underperforming the S&P 500 by 70% since the Fed started hiking rates. But David Auerbach says that pain may be the setup. The chief investment officer at Hoya Capital Real Estate joins us now, and he says balance sheets are sound, new supply is limited, and data centers are the only bright spot. David, it's I guess, you know, they can't really go much further down if they've underperformed by that much.
One would like to think so. I like to say that the REITs are like your graduating class in high school. You had the top 10%, the valedictorian, the REITs in the S&P 500. You had the bottom 10%, the bullies, the troublemakers, the REITs that have cut dividends or over-levered. But what's really to focus on is that middle part of the curve, the students that go under the radar, the small and mid-cap REITs that are putting up solid results, raising dividends. There's really good stories that are out there. From a very high level, of the 100-plus REITs that announced full-year earnings guidance, just in this past quarter, more than 2/3 raised their guidance. More than 60% of the REITs raised their net operating income guidance. Year to date, over 30 REITs have raised their dividends. It's a slow and steady race. When people think about REITs, they're like, oh, REITs are interest rate sensitive. Well, the end consumer that uses these properties and products doesn't think about interest rates when they're interacting with these properties. And so as a result, we're using REITs every single day. We are sitting in a REIT-owned property right now, as an example. To watch this video on YouTube later today, you're using a REIT. So we interact with REITs so much that I feel like the overall sector gets lost in the negative headlines where there's some really good stories that are out there.
But you write about this idea that there are fewer public REITs right now, and something Matt and I have talked a lot about the overall equity market, how it's been shrinking and the amount of public companies that are listed has been less and less. How acute is that problem in REITs, and what does it mean about the opportunity set that you see?
Boy, it's been a crazy quarter. If you go back to 2022, coming out of the COVID cycle, 36 REITs have either explored options, merged, or gone away. In the past couple of months alone, more than 10 REITs are in play. So it presents opportunities for management teams to unlock value for their shareholders, whether it's accessing the debt market, and the debt markets are wide open for REITs right now. Issuing preferred stocks. We just saw the second REIT launch the second equity preferred offering in years just this morning. But also less properties that are out there, more in private hands. So there is some give and take that comes with that.
In terms of the property types that look healthiest, I mean, it's always been student housing, right? Medical offices, I guess senior living. But now you add data centers to it. Is that the full list?
So for sure, senior housing. That is probably the top of the list of all of those
Even
sectors.
better than university dorms.
There is no more student housing publicly traded REITs. Blackstone bought the last one just a couple of years ago. But when you think about senior housing, look, we're a couple of minutes older than when we started this conversation. There's a lack of supply for the amount of baby boomers and Gen X and folks that are going to be living in these properties down the road. So that is the number one.
Gen X isn't there yet, dude. Chill out with that.
But they're thinking ahead. Data centers, obviously AI, every single sector has AI implications, for sure, data centers. But then there's other great sectors, billboards, a great example, Warren Buffett, last quarterly earnings release. Everybody talked about how he invested in, I believe it was in D.R. Horton, but what they didn't focus on was that they established a stake in Lamar Advertising Outdoor, a billboard REIT, LAMR. So that's another good example. Retail, you guys have Stephen Yalof from Tanger on as guests on your channel very frequently, and he's talking about experiential offerings, double-digit rent growth that they're seeing. The high-end consumer and those properties, whether it's luxury hotel, retail, et cetera, they are kicking butt and taking names. It's the other end of the spectrum that are seeing some of those issues with weakness.
When it comes to residential housing, it's been a really big focus of this administration in trying to promote affordability, considering how big of a theme it is. In recent days, we've had the idea of a 50-year mortgage floated or a portable mortgage being floated as well. How much of that would alter the housing space, and would it make it more or less attractive to you as an investor?
I would say on the surface, it might be a positive with an asterisk and a but, because the key issue here is housing affordability. Put it simply, homes are unaffordable to the average consumer. Mortgage rates are still highly elevated. We still see the opportunity, frankly, in the apartment REITs, in the single-family rental REITs. Single-family is a good example because you look at all of the institutional capital that's chasing that sector right now. If we can start producing product that makes it more affordable for the end consumer to live in these properties, then we can finally start tapping into this housing demand that's out there. I think the 50-year mortgage or the portable mortgage is just, frankly, one little arrow in the entire quiver of things that they can do to make it more affordable for consumers.
But, I mean, if you continue to make it a 50-year mortgage, then a 100-year mortgage, then a 1,000-year, like past your death, we're just putting a Band-Aid on this economic problem that we have, right? What do you think of the broader economy? Everyone's talking about the K-shaped economy. The lower half is not able to afford food anymore. What does that mean for your business?
It definitely has severe implications. There's no question about it. But again, you have to peel back the layers of the onion to look at it from the REIT fundamentals perspective. And so as a result, you're right, there are some issues. I think for a lot of these management teams, the job, though, is to keep the blinders on, figure out ways, how do we maximize revenue growth, minimize our expense growth, and push out as much of our net income or dividends as possible to shareholders. Look, REITs have long-term leases in place. You want a short lease, go rent a hotel room for one night. But when you take down an office lease at One Vanderbilt down the street or the Empire State Building, which you can buy, by the way, for $7 a share right now, the Empire State Building. These leases are 10, 25, 50 years, safe hold, ground lease, 99-year lease term as an example. So I think when you look at the embedded rent growth that's in place with a lot of these leases, this provides that income stream that investors are looking for.
Why do you like retail with all of this? That's an interesting one, especially K-shaped economy. People are spending less, and you have the longer-term trend of people just not going in person to stores as much. Why is that an attractive industry?
I think when you look at, so a great example is Simon Property Group, the 800-pound gorilla in the mall space. They just raised their dividend for the 14th time coming out of 2022. These guys are trying to figure out what tenants can can we put in place that we can't replicate online? We're not going to showroom the product necessarily, but also meet needs to our consumers. Is a good example, Netflix. You know, Netflix is launching this entertainment concept at a handful of malls across the country. And there's other examples of some of these experiential retailer properties that are trying to draw in families. You know, how can I draw in a family to come hang out at my property for 10 hours in a given day? So a Netflix opportunity, you have Build-A-Bear or, you know, American Dollar, some of these other things that are trying to draw the family to the store.
I think Build-A-Bear has had like excellent returns recently, so point very well taken. Dave, thank you so much for joining us. That's Dave Auerbach of Hoya Capital. A quick check on markets this morning, over an hour into your trading day, and we are still looking weaker. The NASDAQ 100 falling for a third consecutive day, down more than 1%. It's higher yields that are weighing on it this morning as the odds of a December rate cut get closer to 50-50 with some of the more recent hawkish Fed speak. Your S&P 500 session down about 0.75% this morning, Matt.
Let's get a look at some of the single stocks that we're watching at the moment. In terms of Fannie and Freddie movements, they've been pretty spectacular this morning as the Trump administration explores the possibility of the 50-year mortgage. We heard Kevin Hassett talk about that. The portable mortgage may be something that's a little bit scarier to investors, which would let people move homes under a fixed mortgage rate.
Meanwhile, Pfizer is looking to sell its remaining stake in COVID vaccine partner BioNTech. That's according to sources who have talked to us.
And memory chip makers are down after a Japanese peer reported earnings that showed revenue falling 16% from a year ago. As a result, Micron, SanDisk, and Western Digital all fall down.
Coming up, investors try to fill an economic data void. We'll get insight from Goldman's chief U.S. economist, David Mericle. That's coming up next on Bloomberg Open Interest.
I'll sign a bill exactly like we asked Democrats to send us all along, many days ago. This cost the country $1.5 trillion, this little excursion that they took us on. It's an honor now to sign this incredible bill and get our country working again. Thank you.
The little excursion comes to an end. President Trump speaking after signing legislation to end the longest government shutdown in U.S. history. It funds most of the government through January 30th, setting up the stage for another shutdown fight in 2 months' time. Bloomberg Washington correspondent Tyler Kendall joins us now. So Tyler, yippee, we get to do this all again. But considering we just had the longest shutdown in U.S. history, what are some of the scars that might be left over from it?
Yeah, hey, Dani, good morning. Well, for one, it's going to take a while for the federal government to restart again. For example, we heard from the Transportation Secretary Sean Duffy earlier, who said that it's going to be at least a week before we see those flight restrictions starting to be pulled. Also, millions of Americans who were unable to get their full SNAP food benefits are still facing delays. Many state governments have advised that it could take another few weeks for them to be fully reimbursed their full amounts for November. And then, of course, the lack of economic data, which has, of course, clouded the economic picture and forecast, as we did hear from the NEC director, Kevin Hassett, earlier today, suggesting that we may not get an unemployment rate when the October payrolls report does potentially come out. Of course, the White House press secretary had caused a little confusion yesterday when she suggested that we may never get this data because there has been a black hole when it comes to collecting it, as these employees have been furloughed. So there's definitely going to be some long-term economic impacts here, as our own analysts at Bloomberg Economics have estimated that the shutdown cost the U.S. federal government $15 billion each week that it was closed. Going forward, though, as you alluded to, this is a stopgap measure that funds the government until September 30th. We, of course, don't want to sound pessimistic, but I will say that I asked one top Republican strategist last night on Balance of Power how likely it is we're going to shut down again in January. And Dani, she gave it a 50-50 chance.
Tyler, President Trump says the Democrats have been using these Epstein emails to distract the American public from the shutdown that they created. That's his accusation. But I wonder what we're going to get in terms of actual file releases. There was another representative finally sworn in yesterday. She added her signature to, I guess, a document that's going to push the release of the Epstein files towards the Senate. Are Republicans going to allow this information to come out to the public?
Right. So, Matt, there are two tranches of files that we're talking about here. There's one, the 20,000 emails that we saw released yesterday from the House Oversight Committee. And then there are these other files that we are seeing a push for their release from the Department of Justice. As you mentioned, there are now enough signatures on that discharge petition, which would force a vote in the House. It does look likely that that vote could ultimately go through. We've already seen many Republicans come out and say that they would support the release of these documents. But you're exactly right. After that passes, it would then go to the Senate, and it's hard to see how this would pass the Senate. There are 53 Republicans. It would need 60 votes ultimately for that to happen. And then it would have to go to President Trump's desk for final approval, and he would very likely veto it, not sign it. So it's unclear if we're actually going to see the release, but it's definitely adding and mounting the political pressure on this White House, considering that President Trump had campaigned during the election that we would see the release of these files. Of course, Matt, we should say that the White House and President Trump maintain that he has had no knowledge or involvement in any of the wrongdoing connected to Jeffrey Epstein's crimes.
Tyler, we appreciate the update. That's Bloomberg's Tyler Kendall. And as she mentioned, the October jobs report will be missing a key piece of data, the unemployment rate. White House economist Kevin Hassett says that the household survey wasn't conducted because of the government shutdown, meaning the report will only include job gains from businesses this month. Joining us now is David Mericle, chief U.S. economist at Goldman Sachs. David, maybe you add in Caroline Leavitt, the White House press secretary, saying CPI won't be released. We don't know whether that's the case or not. But what difference will it make to not have these pieces of October data released to the public?
I think we will have some labor market data. We'll probably wind up missing some as well. In general, we think that data that come from company electronic records, like the payrolls numbers, should be okay. After all, we get some of those late every month, and it looks to us like there's no systematic difference between the on-time and the late submissions. Unfortunately, when you get into things like prices, you mentioned the CPI, if people aren't out there collecting the data, then we simply can't go back in time and make them up. And with questions that ask the public, things like, are you unemployed, in surveys, turns out asking 5 weeks after the fact yields unreliable results. So I think that is right. Now, I think the shutdown is ending early enough that probably we should be able to collect reasonably accurate data for the month of November. They will be about a week late on the household survey, which provides the unemployment rate. And you do worry a little bit that if we don't follow the usual schedule, the seasonal factors might not be totally reliable, totally accurate, and the data might not be quite as reliable as we would like. But I suspect for November, while the report might come out late, we will have both the payrolls numbers and the unemployment rate. It should just be the October number that, unfortunately, we wind up missing.
We don't really need to see the official data to know that a huge portion of U.S. consumers are suffering right now on higher prices and uncertainty about jobs, slower wage growth. Is a Fed cut or a series of Fed cuts, is that really going to help the bottom quintiles of the U.S. public?
I think we do expect another cut at the December meeting. That would make 3 in a row. I do think that will help somewhat in pushing up demand. In general, we find that lower income groups' wage growth rates and employment prospects and labor market outcomes broadly are a lot more sensitive to the strength of the labor market and the cyclical position of the economy than, say, higher income groups. So I think rate cuts will help in targeting that group simply because they're a little bit more sensitive to the state of things. Part of the reason that we do continue to think that the Fed will go ahead and deliver that third cut is that it looked like job growth, hiring, was too weak to keep up with labor supply growth. That's why we think the unemployment rate went up 1/10 in July and August, and that's why many other alternative data measures that are still available suggest that the labor market has continued to soften even after those August official data through September and October. So I think there is a case for cutting already based on weak hiring, and increasingly, one hears more chatter and sees some signs in alternative data of a potential pickup in layoffs. So now, if anything, I would say the risks look a little bit greater than when the Fed started on this cutting cycle, which to my mind only strengthens the case for a December cut.
David, well, as John Farrell likes to say, there's what the Fed should do and what they will do. The hawks have been very loud as of late. Collins yesterday of the Boston Fed saying it will likely be appropriate to keep policy rates at the current level for some time. The Fed's daily more recently saying that there's a premium on waiting to decide on rates until you have as much information as possible. David, does it sound like an FOMC ready to cut in December?
I think the reality is not that many people have changed their mind because we haven't gotten a whole lot of data. We already saw these divisions at the time of the September meeting. It was clear that there was a large minority that didn't want to cut beyond September, wasn't happy that they cut in October, probably won't want to cut at the December meeting either. But I think a majority of the voters will want to cut. I think the leadership will likely want to cut. So while there will be some opposition, which I understand, it is a little bit unclear where job growth is in light of the large revisions that we've had to payrolls and the missing data for recent months. It is a little bit unclear how many jobs we need in light of the sharp changes in immigration. And I think reasonable people can have different views on the appropriateness of cutting given where inflation is. I'm not worried about it. I think the Fed leadership is not worried about it. And I think it's fine to say, actually, net of tariffs, inflation is coming down. But clearly, some Fed officials would like to wait for that to happen before cutting. So, there are two kind of reasonable sets of views here, but I continue to think that the leadership will feel that the labor market risks warrant a cut in December and will be able to get the votes to push that through.
Do you say net of tariffs because you expect that to just be a one-time effect? And I mean, other than making things even more unaffordable for most people, not a big deal in terms of, the way economists see it?
I think that's right. What you would worry about in a situation like this, conceptually, it is a one-time increase in the price level. What you wonder about a little bit is, will people start to get a little too accustomed to larger than usual price rises so that even after the tariff-induced price increases have happened, people continue raising prices more than usual?
Well, doesn't it also, David, look like companies are sort of divvying out the increases? Like they'll take the hit to margins and only raise prices a little bit, but raise them a little more next time and a little more. So eventually they get that back.
That would be our assumption as well. So far, we estimate that a little more than half of the cost of the tariffs have been passed through. My guess is some companies want to see a little bit more finality on whether or not these tariffs are going to stick. After all, we do have a Supreme Court case pending at the moment, and it's not clear what the policy will be after all of that. So my guess is you're right. Some companies are probably waiting. There will be a bit more pass-through. Our estimates suggest there's less ahead of us than there is behind us. And while I think that the additional effects will be enough to keep inflation more or less steady for the next half year, I don't think they'll be large enough to push inflation up a lot or really make people think that it's normal to raise prices at a much higher rate. So in that sense, I would sympathize with the view of Chair Powell that it's okay to say, we're going to look through this. This is a one-time effect. And when you do that, inflation's not quite at 2, but it is still moving the right direction. It is below 2.5. And I feel fairly confident that it will keep moving in the right direction.
David, really appreciate your time and your intel. David Mericle there, Chief U.S. Economist at Goldman Sachs. This is Bloomberg Open Interest. This is Bloomberg Open Interest. I'm Matt Miller. Let's get a check on the markets. Just about an hour and a half into the session, we're looking at red. In fact, pretty serious drops now. The S&P 500 off more than 1%. The Nasdaq down almost 1 2/3%. This as Nvidia weighs on the market, and you got an earnings disappointment, a revenue disappointment from Disney. Take a look at Nvidia right now, down more than 4%. So a bigger drop than we had on Tuesday. Remember, Tuesday we had a 3% drop, but we still had the markets eking out a gain. Cisco, on the other hand, is on the upside. Dani, we have a packed show tomorrow.
Yeah, we did. Let's go through it because we're going to be speaking to Jim Caron of Morgan Stanley and Paisley Nardini of Simplify Asset Management. Plus, we'll be speaking with Churchill Asset Management CEO Ken Kinsell about private markets and the Bentley CEO will also be joining us, Matt.
For me, for Hannah Elliott, for Hot Pursuit, it's going to be a really interesting episode because Frank used to work at Porsche. He designed the 918, their most famous supercar, I would argue. And Jim Caron works on his own Harleys. This is Bloomberg Open Interest.